Vanakkam, Namaskar दोस्तों. Each and every day, there are thousands and thousands of people entering new into share market. Everyone wants to make profits. Some come well prepared and with the hope that they can make money. Some come only with the hope believing luck will help them. Today, the topic we are going to discuss is PE ratio. चलिए अभी शुरू करते हैं. So, we have a common belief that low PE stocks are undervalued and good. High PE stocks are overvalued and avoided. सो काफ़ी समय ऐसा होता है जब पी रेशियो कम है तो हम उसी स्टॉक्स पर इन्वेस्ट करते हैं और पी रेशियो ज़्यादा मतलब ओवर वैल्यूड सो हम इग्नोर करते हैं. जी बिल्कुल ऐसा नहीं है. सो इस एग्जाम्पल पर देखिए, कंपनी एक्स स्टॉक प्राइस हैज़ 10 and its earnings are 5, so its PE ratio is 2, and company Y has a stock price of 20 and its earnings is 2, so its PE ratio is 10, so which is high comparing to company X. Company Y has a high PE ratio. So what does this mean? So should we buy company X because it is having a low PE ratio? जी नहीं. So इसका we have a common like belief that low PE stocks are undervalued. So what we are going to do is, not we are from this example we are going to learn that not all low PE stocks are good for investing and not all high PE stocks are bad for investing. So the common max rule before entering into this lesson we have to learn is numerator divided by denominator. This we have learned in fraction in our schooling days. So if the values in denominator is high, then the resultant value will be low, and it is vice versa. So the basic formula for PE ratio is PE ratio is equal to stock price divided by earnings per share. Stock price is on that particular day, what is the price of that stock, and divided by, in the denominator we'll get earnings of that per share. So we are going to do prediction on future PE for company X and Y. So देखिए, company X, the first year it has a profit of 5 rupees, so its PE ratio is 2. On the other hand, company Y has a earnings of 2 rupees on the year 1, so its PE ratio is 10. Suppose we are planning to invest in this any one of the companies in the year 1, which company will invest? For example, assuming if a investor invest considering a low PE stock, that is he has chosen company X because its PE ratio is 2 comparing to PE ratio of 10. So if he invest in this stock without assessing the future PE and the growth of the company, the next second year the company X has a earnings of 3 rupees. So the PE ratio increases by 1, so it is 3. In the third year, company's earnings decreases to 2, so the PE ratio increases to 4. So the earnings or profits of a company X goes on decreasing and the PE ratio goes on increasing. The stock price gradually decreases. So if an investor thinks to buy a company Y, even though if it has a high PE ratio, but he assumes that the year going by the company's earnings or profits will increase. So a second year the company's profits increases to 10 from 2, and the third year company's profits increases to 20 from 10. So the PE ratio first year is 10 and the second year is 3 and the third year is it's 2. It goes on decreasing. So this is the condition we are getting to know from this. Look at the graph from the above tables. The graph is a PE ratio goes on increasing year on year if you had bought a low PE stock and if its future earnings are very less, that is future growth of a company is very less, 2, 3, 4. Look at this graph. If we had bought a high PE stock and if its future earnings are good, then the PE ratio goes on decreasing and the earnings goes on increasing. So coming to the formal definition, we'll come to the formal definition. A PE ratio or price to earnings ratio refers valuing a company. It measures its current share price relative to its per share earnings. Current share price means current stock price to its per share earnings. मतलब earnings or profits of a share. So formula is this: if we should not blind believe in this benchmark that lower the PE it is better. So it is a red signal for an investor. Does it apply for all the stocks? Yes, of course. What are the classifications? Is there any classification? Yes, of course, they are classified into forward PE, that is future PE, and the trailing PE, and which is the past PE. So, coming to the real time example, see, we have taken a two example based on the sectors. One is based on last year 2019 September, and the other one is September 2020, the current year. We have four sectors. One is FMCG, the other one is oil and gas, the other one is bank, the other one is mining. So first we'll look at the FMCG sector. So look here, the earnings is 29 for the year last year 2019, and this year due to the pandemic the earnings remain the same, they have not decreased. Look at the PE ratio, it is 62 for the year 2019, and there is a slight increase in PE ratio of 71 for the Hindustan Unilever Limited. But considering high PE, should we ignore it? The Hindustan Unilever, as we all know, has a good profit making and their earnings are consistently increasing. So look at this. Their stock price has increased from 1830 to 2077. So coming to the next sector, which is oil and gas, we have taken Indian Oil Corporation. So if we look at the earnings of Indian Oil Corporation 2019 September, it is 14.28. Look at the same earnings this year due to the pandemic, September 2020, it is 0. Look at the drastic changes. So the PE ratio which was 10 last year, it is 0 this year. So considering this, if it is 0, very low, should we invest in this stock? No. This is highly volatile and we have to see the future earnings and the past earnings. So there are two PEs which is involved. So we have to consider the future PE and as well as past PE. We have to analyze future earnings as well as past earnings. If you take the banking stock, there is no much difference in earnings, but they have increased. HDFC Bank, look at HDFC Bank. So last year it was 44.21 and this year it is 49.69. Look at the mining. Last year it was 16 and this year it has increased to 18. And the PE ratio, last year it was 11 and this year it is 6. So based on the sectors it varies PE ratio. So there are some sectors which are sometimes volatile and we inconsistent. So we have to analyze the past and future earnings and the PE ratios. We have to take an assumption of future PE as well, and past PE we can take it from the records we have. So hope this video was helpful regarding the PE ratios. Thank you guys.